Market is neutral. It does not wake up angry at you. It does not remember your last trade. It does not care if you need to win today. Price moves without intention, no judgment, no emotion, no obligation to reward effort or punish mistakes. Every trader who believes the market is against them has already lost clarity. Loss does not come from the chart. It comes from the interpretation of the chart, from the meaning you assign to movement, from the story you tell yourself while price is doing nothing more than existing. The market offers information. You decide how to respond. That response determines everything. Two traders can see the same setup. One waits. One rushes. One sizes correctly. One overcommits. One exits clean. One freezes. Same market. Different mind. Different outcome. Blaming the market is a refusal to take responsibility. It's easier to call it manipulation than admit impatience. Easier to accuse randomness than confront impulsiveness. The market doesn't cause revenge trading. Ego does. The market doesn't force overtrading. Fear of missing out does. The market doesn't demand oversized positions. Insecurity does. When traders say the market is hard, what they really mean is that it exposes weakness. It reveals poor risk tolerance. It reveals the need to be right. It reveals the inability to sit still. The market simply reflects you back to yourself, unfiltered, unforgiving. Every emotional spike you feel comes from attachment. Attachment to outcome. Attachment to money. Attachment to identity. The moment you need the market to give you something, you lose objectivity. You stop seeing probability. You start seeing hope. The market is not personal, but your reactions are. You cannot control volatility. You cannot control news. You cannot control other participants. You can control one thing, execution, and execution lies entirely in the mind. If your mind is undisciplined, no strategy will save you. If your mind is reactive, every setup becomes dangerous. If your mind is impatient, even good trades turn bad. The strongest traders are not emotionally invested. They are emotionally neutral. They don't need action to feel validated. They don't need wins to feel competent. They accept uncertainty without flinching. They accept loss without drama. They accept waiting without discomfort. That neutrality is power. The moment you stop fighting the market, you start seeing clearly. The moment you stop blaming it, you start correcting yourself. And the moment you accept that the enemy is internal, progress becomes possible. The market isn't here to hurt you. It's here to test whether you can master yourself under pressure. And most fail that test not because the market is cruel, but because their mind is undisciplined. Waiting is not weakness. It only feels that way to an undisciplined mind. An undisciplined mind equates movement with progress. Silence feels like failure. Inactivity feels like falling behind. But the market does not reward urgency. It rewards alignment. Every impulsive trade is proof that patience broke before opportunity arrived. Every forced entry is an admission that waiting felt unbearable. Most traders are not defeated by bad setups. They are defeated by time, by the minutes between clarity and execution, by the hours where nothing happens and discipline erodes. Waiting exposes the truth. It shows you how much you depend on action for emotional relief. It reveals whether you trust your process or just your impulses. The market spends most of its life doing nothing worth trading. Yet traders feel entitled to participation. They believe presence equals progress. Professional discipline begins with restraint, with the ability to watch price move and feel no obligation to act, with the ability to let 10 trades pass to protect capital for one. Waiting is not passive. It is active restraint, a conscious decision to preserve clarity. Every time you wait, you are choosing long-term survival over short-term stimulation. Every time you don't trade, you reinforce self-control. Every time you sit through boredom without clicking, you build mental toughness. Impatience costs more than bad analysis ever will. It sneaks in quietly. It disguises itself as confidence. It whispers that this is close enough. Close enough is where accounts bleed. Waiting requires discomfort tolerance, the ability to sit with uncertainty, the ability to not know when the next opportunity will come and remain calm. Most traders fail here. They trade to escape that discomfort. They trade to feel involved. They trade to avoid silence. The market punishes that need relentlessly. True discipline means accepting that missed trades are irrelevant. There will always be another setup. There will always be another day. But capital lost to impatience does not return easily. Waiting protects objectivity. It keeps you detached from noise. It prevents emotional contamination. The trader who waits controls risk before it ever exists. The trader who rushes reacts after damage is done. You don't wait because you're afraid. You wait because you're selective. You wait because you understand that capital is ammunition, not entertainment. Waiting is the filter that separates professionals from gamblers. Gamblers need action. Professionals need alignment. The longer you can wait without emotional leakage, the more dangerous you become in the market. Because when opportunity finally arrives, your mind is clear, your size is controlled, and your execution is clean. Waiting is not a lack of confidence. It is confidence without noise. And only traders who master waiting ever experience consistency. Losses are acceptable. Loss of control is not. Every trader who survives long enough learns this the hard way, not through theory, through pain. The market demands payment for participation. Losses are that payment. They are unavoidable, built into the structure of probability. What destroys traders is not losing, it's how they respond when they do. A controlled loss is a professional decision. An uncontrolled loss is emotional negligence. The moment a loss threatens your identity, discipline collapses. You hesitate, you hope, you negotiate with price. Hope has no place in execution. Small losses keep you honest. They confirm that you respect risk. They remind you that no setup is guaranteed. Large losses expose a denial. They reveal the inability to accept being wrong quickly. They show where ego overruled rules. The market does not punish mistakes. It punishes refusal to correct them. The first loss is information. The second is confirmation. Anything beyond that is stubbornness. Control means predefining pain, knowing exactly where you are wrong before you enter, accepting that outcome without resistance. If you can't accept the stop, you shouldn't take the trade. Most traders don't fear losing money. They fear admitting they were wrong. So they stay, they add, they rationalize. That behavior turns manageable losses into account damage. Discipline is not about avoiding losses. It's about keeping them small, boring, and forgettable. The best traders don't remember their losing trades. They remember their rule violations. A clean loss strengthens confidence because it proves you followed your process under pressure. An ugly loss erodes trust in yourself, not because of the money, but because you know you abandoned discipline. Control under loss is the true test of a trader. Anyone can follow rules while winning. Few can do it while losing. The market watches behavior, not intentions. It rewards consistency of execution over time. When you lose control, size increases, stops move, rules bend. That spiral has ended more careers than bad strategy ever has. Accept losses as part of the profession. Reject chaos completely. The moment you feel the urge to fight a loss, step away. That urge is the warning sign. It tells you objectivity is gone. Professional traders don't recover losses. They execute the next trade correctly. Control is capital. Once it's gone, no edge survives. Losses will come. That is not optional. But loss of discipline is a choice, and that choice determines whether you stay in this game or disappear from it. Capital grows only after restraint is proven, not before, never before. The market does not reward ambition. It rewards evidence. Every increase in size is a test of patience, a test of emotional control, a test of whether discipline holds under pressure. Most traders fail this test because they rush it. They confuse a winning streak with mastery. They interpret short-term success as permission to expand. That mistake is expensive. Restraint is proof of readiness. If you cannot trade small with consistency, you cannot trade big with stability. Size does not create skill. It exposes the lack of it. Small capital teaches respect. It forces precision. It magnifies mistakes just enough to be felt, not enough to be fatal. When traders increase size without restraint, the mind changes, stops feel tighter. Losses feel personal. Decision-making deteriorates. Capital growth must follow behavior, not emotion. You earn expansion by repeating discipline under boredom, under drawdowns, under winning streaks. The market watches what you do when thin. JEESE are going well. That's when most damage is done. Restraint means refusing to scale until execution is boring. until rules are followed automatically, until losses are taken without hesitation. If you need excitement to trade, you are not ready for growth. If you need constant action, size will destroy you. Scaling is not a reward, it is a responsibility. More capital does not mean more opportunity, it means more consequence. Every added dollar amplifies psychological pressure, every increased position magnifies flaws. The disciplined trader increases size slowly, methodically, only when results are stable across time, not days. Restraint delays gratification, and that delay is exactly what filters out reckless behavior. The market does not care how badly you want to grow. It only responds to demonstrated control. Traders who respect restraint understand that capital is not income. It is inventory. It must be protected before it can be deployed. Expansion without restraint is gambling disguised as confidence. True growth feels anticlimactic. No rush, no adrenaline, just repetition. When restraint is proven, growth becomes sustainable. When it isn't, expansion accelerates collapse. The market has no sympathy for impatience. It does not negotiate size with ego. You don't scale because you feel ready. You scale because your behavior proves it over time. Restraint is the gatekeeper. Without it, capital never lasts. And without lasting capital, nothing else matters. Overtrading is emotional leakage, not strategy. It is the visible symptom of an internal imbalance. No one overtrades because the setup demanded it. They overtrade because something inside them is unsettled. The urge to click is rarely about opportunity. It's about relief. Relief from boredom, relief from anxiety, relief from the discomfort of waiting. Overtrading begins when trading becomes emotional regulation instead of execution. When the screen turns into a distraction, when activity replaces discipline, the market does not reward presence. It rewards precision. Every unnecessary trade dilutes focus. It lowers standards. It trains the mind to accept mediocrity. Most traders don't realize they're overtrading until damage is done, because each trade feels justified in isolation. It's only in accumulation that the problem becomes visible. Overtrading erodes edge quietly. It blurs decision-making. It increases exposure without increasing probability. The more you trade, the more emotional residue builds. Frustration from losses, euphoria from wins, impatience from inactivity. That residue clouds judgment. A professional does not trade to feel involved. They trade to execute a specific condition. Everything else is noise. Overtrading often follows a loss. The mind seeks to correct discomfort quickly. It wants resolution, not correctness. That urgency is dangerous. It shortens time frames. It weakens criteria. It replaces planning with reaction. Strategy does not demand constant action. Ego does. If your day ends with exhaustion instead of clarity, you traded too much. If you can't remember why you entered a position, you traded too much. If your rules feel flexible by midday, you traded too much. Restraint is the antidote. Limiting trades protects discipline. Reducing frequency preserves objectivity. Fewer trades mean higher standards. Higher standards mean cleaner execution. Cleaner execution means consistency. The market is not impressed by effort. It does not reward volume. It rewards selectivity. Overtrading is a form of self-sabotage, disguised as ambition. It feels productive while quietly draining capital and confidence. The solution is not more analysis. It is less activity. When you remove unnecessary trades, edge becomes visible. Again, clarity returns. Confidence stabilizes. You don't need to be in the market all the time. You need to be right when you are. Overtrading is not a market problem. It is an emotional one. And until that is addressed, no strategy will hold. Self-mastery precedes financial mastery. Always. No trader outperforms their discipline for long. No edge survives emotional chaos. No amount of intelligence compensates for lack of control. The market amplifies who you already are. If you are impulsive, it magnifies impulsiveness. If you are patient, it rewards patience. Trading is a mirror with no mercy. It reflects habits instantly and charges real money for denial. Most traders search for mastery in charts, indicators, and systems. They avoid the harder work, the internal work, because controlling the self is uncomfortable. It requires honesty without excuses. It demands accountability without relief. You cannot lie to the market, but you can lie to yourself, and that lie will be expensive. Self-mastery means understanding your triggers, knowing when ego enters, recognizing when fear tightens decision-making. It means stepping away when clarity fades. It means following rules when emotions argue otherwise. Financial mastery is the byproduct. It comes after behavior stabilizes, not before. Traders who skip self-mastery experience temporary success, then collapse. When pressure increases, habits take over. Under stress, you don't rise to your goals. You fall to your training. If your training is undisciplined, pressure will expose it. Self-mastery is built in repetition, in boring days executed correctly, in losses accepted cleanly, in rules followed without exception. It is built when no one is watching, when there is nothing to gain immediately. The strongest traders are internally quiet. They do not argue with the market. They do not chase for leader. Sean. They execute. They record. They step away. They know that confidence comes from integrity with their process, not from profits. Money is loud. It amplifies emotion. Without self-mastery, it destabilizes. With self-mastery, it becomes neutral. The goal is not to feel fearless. The goal is to act correctly despite fear. The goal is not to eliminate emotion. The goal is to prevent emotion from influencing execution. When self-mastery is present, patience is natural. Losses are tolerable. Waiting is effortless. Without it, every trade is a struggle. The market rewards those who have already mastered themselves elsewhere, those who can delay gratification.